Hello guys and girls, and welcome to episode 1. It's an absolute pleasure to have you here, and I'm really excited for you to go through the content. Now, speaking of content, it's really important for you to understand what is the most efficient way for you to learn. What's the most efficient way for you to consume that content so you can apply it? Now, I introduced a concept into Falcon called the 3-step process, and we found that this process has been the leading factor into so many people's breakthroughs and progression. So what is the 3-step process and how can you utilize it? Well, essentially it goes like this. The first step, what you do is that any content that you're watching or reading, you go through this 3 times. And the first step is where you just go through it all the way through without taking any notes. So let's say, for example, you've got episode 1. You're going to go through that all the way through. You're going to sit back, relax, not take any notes whatsoever, and you're just going to consume it. The second time, this is where you watch it again and you take notes. You're going to find that you take way more notes than what you would if you took it the first time. The third time, this is the most crucial. This is where you're going to reflect on the notes that you took, and you're going to take away all of these key things that you probably didn't even realize, things that you didn't pick up the first time. And it's a little bit like watching a film, right? We've all watched a film before and we can't even remember half of it. It's the same watching content for the first time. When you go through it again, you pick up things that you didn't realize. It's also like reading a book. When you read a book for the first time, you might forget chapter 4 or chapter 5. And when you go over it again and again, you pick up key things. And it's those little breakthroughs that lead to so much more efficient ways for you to progress as a trader. And this is going to be a key thing throughout your Falcon journey. Now moving on to what you're going to learn in this episode. Well, in this episode, we're actually going to take it back to a few basics. So if you're a complete beginner and you're wondering, I need to learn all of the concepts of the Forex market, we're going to take you through that. If you've been a trader for a while and you're familiar with these things, then that's absolutely fine. This is just going to refresh your memory. We're also going to be diving into some key concepts as well about Falcon, what it stands for, and some key components. And also going into the psychology of why people struggle. What are the bad habits that they fall into? And how can you as a trader put yourself into that 10% where people are actually succeeding? Guys and girls, I'm really excited. So let's just dive straight in. Hello guys and girls, so welcome to episode 1. Very, very excited to get into this. What we're going to do is just start off very, very basic and we're going to work our way up. And as the course progresses, it gets more and more advanced. If you're completely brand new to Forex, and of course this is going to teach you the basics. And as you grow and learn all of the concepts, each one builds on each other. So excited to get into it. Let's start off with the first part. So what is Forex? If you've not traded Forex before, then let's just keep things as simple as possible. Forex is simply the buying and selling of currencies on a global market, which operates 24 hours a day, 5 days a week. Now, as a Falcon member, you will be shown step by step how to trade the FX market profitably and on a consistent basis, which is the most important thing. Now, when it comes to currencies, you may have heard of them before, or this may be the first time. Now, there are a total of 8 major currency pairs that we focus on and really have our attention on within Falcon. This is the Australian dollar, and of course you can see the abbreviation, so AUD, Canadian dollar, the CAD, Swiss, Euro, Great British Pound, Japanese Yen, New Zealand dollar, and the US dollar. So we're pairing these up against each other. Now, as you can see, that there's lots of different variations. So what we do with the currencies, we pair them up against each other, and then we're looking to either the currency to appreciate or depreciate against them. And then we are, of course, utilizing a strategy, which you'll learn how to actually look at which one you're going to take. So keeping it simple, what actually is a currency pair? Well, essentially, a currency pair is simply the exchange rate of one currency matched against another one. So as you can see previously, we had them matched up against each other. So if we look at USD CAD for an example, now USD CAD is currently trading at 1.3140. The first stated in this pair can always be denominated as 1. The current trading price can always be noted as the second currency in this pair. So for example, $1 equals 1.3140 CAD. So as you can see, when it comes to looking at it from that perspective, it's really about keeping things as clear and concise as possible. And this leads me on to, what am I actually doing when I'm trading a currency pair? Well, essentially you're either buying to go long, which you'll hear this term, or you're selling to go short. By going long on USD CAD, you're trading with the expectation that the price of the US dollar is going to rise against the value of the CAD. So you'll naturally be looking for buying positions. By going short on USD CAD, you're trading with the expectation that the price of the US dollar will fall against the value of the CAD. It's really that black and white. So you are trading with the expectation that the current value will change in your outlined direction. By doing so, you're able to profit from these price movements that occur within the market on a day-to-day basis. But what is a pip? So if you're completely new to Forex, you may have not heard of this before. If you've been trading for a while, you'll know what we're talking about. But what is a pip? Well, essentially, a pip is the fourth decimal place in the numeric value that expresses the exchange rate between two currencies. It is the unit for measuring the small movements in price that occur on the FX market. For example, let's take a look at USD CAD again. So USD CAD is trading at 1.2664. When you execute the position long, so you're expecting the US dollar to appreciate over the Canadian dollar, over the next couple of days, price moved up to 1.2964. Let's do the maths. So if we take the first price, so 1.2964, we minus that by 1.2664, that equals 0.0300. So price moved in our direction 0.0300 or 300 pips. So as you can see, it is a lot easier and a lot more simple to measure this in pips. It's easy to get overwhelmed with all of these numbers when really and truly it's simple. And we'll show you, of course, when you set up your trading view and you set up your chart software, what we'll do is we'll show you some tools that helps you measure price a lot easier. But what I want to do now, guys and girls, I want to take you through a mini lesson on a pip to explain that in a little bit more detail so you can see the differences, and especially something on the yen pairs that is worth taking note of. Right, guys and girls, so just a quick mini lesson on pips. So those of you that have been trading for a while, you know exactly what this is, but if you're a complete beginner stepping into Forex or Falcon, then let's go through this and keep it simple. So you would have heard of the term pips. What is a pip? What does it stand for? Essentially, it's just points in percentage. But to keep things as simple as possible, I want to explain these 4 examples because there's something different with yen pairs and the majors, etc. And you'll see this from the decimal places. So let's take pound dollar, for example. So these are quoted to the 4th decimal place. So what does that mean? Well, let's take a look at this bit of price. So let's say, for example, that pound dollar is quoted at 1.2485. And the end figure here, this 4th decimal place, this moves to 9. So what does that mean? That means that we have moved up 4 pips because this has gone from 85 to 89. Now, let's say, for example, that you're taking pound dollar long. You're expecting that the pound's going to appreciate over the US dollar. Now that's increased 4 pips within your favor. So you see how that's quite simple? You're going to see this on your chart. So just so you don't get confused and you start focusing on all these other figures that don't really matter as much, this is what this means. We also have measuring tools within TradingView that you would have configured as well to actually work out the pips and percentages so much easier, but I thought I would explain this as well. Now we move on to euro dollar. So now let's take a look at euro dollar at 1.1150. Now let's say, for example, that this has moved from 50 to 40. What does that mean? Essentially, we've now decreased by 10 points or 10 pips. And essentially, let's say, for example, you was going long on euro dollar. You was expecting the euro to appreciate. And what happens is it moves down. So now that's moved down against where you're expecting price to go. So very, very, very simple when it comes to this. Now, what you may see on your broker sometimes is another decimal place, but you don't need to focus on that. You just ignore that. We're quoted to the 4th decimal place. These are the figures that you need to focus on. But when we come to the yen pairs, they've always been quoted like this. They're actually quoted to the 2nd decimal place. And it's just always been this way. So just in case you get confused when you're looking at these yen pairs compared to these, I wanted to clear that up. So essentially, if we take a look at dollar yen, what do we have? We have dollar yen at 108.20. Same principles as we're following. If we move from 20 to 25, we've now increased by 5 pips. So if you're going long, again, that's moving in your favor, vice versa. Now we go to pound yen. So we've got 134.90, and then we move to 70. So we've gone from 90 to 70, and essentially, as you've probably gathered already, we've moved down 20 pips. Now when you're trading, we're putting stop losses on, for example, by 20 pips. That may have taken you out if you'd gone the other way. So it's just about understanding what the pips mean. But like I said, When you're in TradingView, you're going to be utilizing tools that are much simpler and much more easy. But just in case you've never heard of a pip, when I first started trading 11 years ago, there's so many basic things that I've completely forgotten. So it's always good to refresh my memory and explain these simple things. And if you're completely new to Forex, then just keep it simple. So now moving on from pips, let's actually take a look at the benefits of Forex. So what are the benefits of Forex? Well, Forex offers a lifestyle that may at first seem unattainable for those not involved in the space because people fear what they don't know. It can become your full-time income replacement for your current 9-to-5 job, and it's scalable through consistent results if you do it in the right way. Now, our strategy allows you to cater it to your personality and your lifestyle, so you've got full management over the time that you spend on the charts, which is the most important thing, spending the right amount of time and having that flexible freedom. It presents you the opportunity to essentially become financially free. After all, this is what we want to do, and then be able to actually have our time back. That is the most precious commodity that we have. Now, the next benefit that I want to talk about that may not seem like a benefit at first, but we've got a different sort of take on it. So the 90-90-90 rule. Well, first up, there's a saying that 90% of retail traders lose 90% of their capital in the first 90 days. Unsettling amounts of retail traders trade without any risk prevention, no stop loss, no strategy, and all kinds of horror stories. The uneducated wish to get rich quick naturally. However, trading is a long-term game and it must be treated like a business, which is what we show you how to do that. Falcon teaches you how to cap your downside, but more so maximize your upside potential through a variety of different techniques that you are going to learn over a period of time. The maximum that you may lose on any given position, if you, of course, you're adhering to the Falcon strategy, is 1% of your total account balance. It's really, really important to understand this. If you keep your risk low and you're focusing on the overall bigger picture and you're looking at a decent risk to reward, you'll naturally have the mathematics on your side, which it actually becomes a lot more simple. But what I want to do now is I want to take you through a little bit of visuals on the chart so you can see the benefit of knowing what the 90-90-90 rule is, how to avoid it so you can put yourself in a position of the successful trader. So let's take a look at that now. So now let's take a look at this more visually. So why are people getting caught into this 90-90-90? Why are they losing that money in 90 days? Well, one of the main reasons is that they're getting caught on the wrong side of the market. So what does that mean? Well, in layman terms, essentially what they're doing is they are buying the highs and they're selling the lows. So what happens? Price goes up, 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 and they think, right, I'm going to miss out. Guess what? They start buying in these areas, and then it starts moving to the downside. What also happens? They see price going down, 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 gets to these areas, and they think, wow, I'm going to miss out. I need to start selling, and then what happens? It starts to reverse. And you might ask yourself, well, why is that? Well, this comes in the form of price patterns. Imagine if you knew in these sort of areas when to make sure that you're not getting caught on the wrong side of the market. Let's take a look at this, for example. Now, if you're completely new or you've been trading for a while, you may or may not have heard of something called support and resistance. Now, if you look at something like this would be an area where people would see as resistance. What actually happens here? Well, price actually goes through. So if we take this back to here, you can see the price is now gone through this area of resistance. This is where a lot of people would be thinking, well, we've broken through, now we're looking at this resistance, now is going to become support. Now imagine if you understood particular price patterns that repeat themselves, that have done so over a 30-year basis, that helps you to stay on the right side of the market. That is what we need to focus on. And understanding those concepts, which you're going to learn more in episode 3, all of these patterns, all of the variations to truly give you an edge. But this is what it truly comes down to. That's the psychology. They buy the highs and they sell the lows. They don't really have any real strategy. So understand that you're going to learn all of the concepts, learn how to keep things super simple so you can start capitalizing on all these very, very clear and obvious price patterns. But before we do that, just wanted to give you a very quick glimpse and insight there. Now let's go into a little bit more psychology behind that on a mini lesson. So let's dig into that now. Right, guys and girls, so just a quick mini lesson on the 90-90-90 rule. See, there's a great benefit in understanding what this rule means. Why is that? Well, you've heard the terms 90% of retail traders lose 90% of their money in the first 90 days of trading. Why is that? Why do people fall into this category? Well, there's a number of things that we're going to cover here. But what I want to bring to your awareness and your attention is the benefit of understanding this rule so you can avoid all of those pitfalls and keep yourself in the percentage of people that are actually succeeding. See, if we take a look at this in a little bit more detail and we look at why does this actually happen, the first point I want to talk about is poor risk management. And this comes in the example of what we've got down here. So we've got an example of a £1,000 account risking 10% per trade. Now, some of you that have learned Forex before, you may have even experienced something similar like this. But at Falcon, we stick to 1% per trade of our account balance. And if you think about it from this perspective, because it's normal as a trader, you can take a few losses in a row. We don't know that sequence. You might take 4 or 5 losses in a row. It can happen. If you're risking, let's say, 10% of your £1,000, you're risking 10% of that account. You're risking £100 per trade. Now, let's say, for example, that you do get 4 trades in a row there that happen to be losses. It happens, right? You're now down £400 of that account, but what you're really down is 40%. That's insane. Think about those figures right now. Imagine doing that on a larger account. It'd be very, very emotional. And even on here, it's exactly the same thing. And what tends to happen is that even on 10% of risking that per account, and let's say you do take a few losses, naturally you're going to feel those emotions of, I need to make that money back. And you may have already been there before. So what do? You start risking 15%, 20%, and start having those thoughts that, well, I'll only do this once. And once I build my account back up, then I'll go back to risking small amounts. It rarely happens. That's really that gamblish type mentality that we want to avoid, which really puts people into this 90-90-90. This is how it happens. Because the way you like to think about it, if you're risking 1% of your account per trade, it's very, very difficult to blow your account. And if you're someone who's blown your account before, it's probably because you've got no risk management and you're looking at 10%, 20%, and I've heard some crazy horror stories. But if you risk 1% of your account per trade, it's very, very difficult for that to happen, and it keeps you in this business long enough for you to succeed. And remember, the goal is never to turn the 1,000 into 100 or into 1,000,000. That's not what it's like. What we're doing is building good habits and trading in a way that's scalable and sustainable. So when you're risking 1% of £1,000 from a monetary value point of view, that might not seem very, very exciting at the start, but it's about building those habits, because once you're trading 10K, 100, etc., 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 that 1% accounts for a lot more. So you have to build the good habits on a small account to be able to trade a larger account. But let's go to another reason as to why people fall into this 90-90-90 rule. They trade without a stop loss. This is insane. We've seen the depegging of the Swiss pairs, we've seen flash crashes, we've seen all kinds of things. And although even stop losses, they don't always guarantee where you'll get stopped out, trading without a stop loss is the quickest way to blow your account. And there was a story of a trader that I knew that was holding gold for a very, very long period of time, and he ended up, blowing something like 80% of his account. And the reason was why he just kept holding on to it in hope, as you can see, that it might turn around. But we don't work on hope. We work on logic, on controlling our risk. That's really what we are, risk managers at the end of the day. So trading without a stop loss, if you've done that, please treat this like a business and make sure that you're capping your losses at 1% maximum. That will keep you in the business long enough. No real strategy. This is another point. Now, some people think they're trading a strategy, but they're not. They've got an idea, a rough idea of a strategy, but there's no real plans in place. And through this whole course, you're going to have all of the components to bring this all together, so you know that you're treating it like a business and you have a real strategy. Strategy doesn't just mean that, right, when there's a high test candle at the top of a structure, or if you traded resistance, support and resistance and things like that, that I'm going to sell it because it's a reversal candle. That's not what strategy means. Strategy is a combination of lots of components. This comes in a form of advanced self-review, which you'll learn in the later episodes, and all other kind of things. It's not actually just about technical analysis. Strategy is your whole strategy of how you trade. And a lot of people think they have a strategy, but they don't. And this is what you're going to learn throughout the course, so you're going to absolutely love it. Next part is the get rich quick mindset. I would say this, upon all of that, really sabotages everything. This is really the root of all of the issues. So if you think of it like this, why do you have a get rich quick mindset? Well, you have a get rich quick mindset, and this is why you've got poor risk management, because you want to get rich quick, so you're risking 10% or 20% per trade in hope that it's going to grow really quick, right? Again, short-term thinking. We want to be long-term thinkers. Trading without a stop loss. you don't really want to get stopped out of a trade. So you think that, well, if I don't have a stop loss, eventually it will go in my favor. This is where the ego is involved. And this is, again, you just want to get rich quick. You just want to do whatever you can to stay in positions and get rich quick. No real strategy. This is just reckless and what amateurs do. But judging on yourself, if you're taking this course right now and you're involved in the Falcon community, you're someone who is serious, that wants to now learn the right way, the way that they can sustain this, scale this, and actually grow their account in a way they can do this for the next 10, 15, 20 years. Think about your trading career. Do you really want to fall into this category? So when we see these numbers, it's easy to think, that's quite scary, the 90-90-90 rule. Pure amateurs getting into this rule. I can see how it's very easy to fall in there, and if you've done that, that's fine. But you need to understand what it takes to stay in this game is that you will have periods of losses, you will have periods of winning streaks and losing streaks. But what ultimately gets people to the successful part where they break through to consistency is that they're in this business for long enough to make mistakes that are not costly. Every successful trader makes mistakes, but it's the ones that fall into this category. They're risking 10%, 20% of their account. No wonder they fall into this category. But a lot of these same traders, if they just risked 1% of their account, they would have stayed in this long enough to actually realize their mistakes, rectify them, move forward, and actually break through to consistency, because everybody has the ability to become consistent. And if you can avoid these, you can avoid the 90-90-90 rule. We will keep you as far away from that as possible, but if you follow these concepts, guys and girls. So what I want to do now you understand the 90-90-90 rule, you know how to avoid it, you understand why we want to move away from that. I want to show you just quite simply on just some simple mechanics of an account that will really help you understand, even when you're sticking to low risk, you can still benefit and high rewards. So let's take a look at that now. So this is the example that I want to show you, and it's very, very important for you to understand the mathematics. Now, this is a non-compounded example of what this means. So this is more the concept of the mathematics and what you can achieve even on a slightly lower strike rate. So let's take a look at this. Let's say we have a £10,000 account. Whether you're starting with that now or something you aspire to be, that will be very attainable to you. So when we take a look at this, if we're risking 1% of our 10,000, how much are we risking per trade? That's the most important thing. We're risking £100 per trade. Let's say on average, we average out 10 trades per month. Now, if we're taking 10 trades and we have a win ratio of 50% and a lose ratio of 50%, we have a 50% strike rate. Now, this is really an average strike rate as you're building up towards consistency. And the thing is, you can still become consistent on a lower strike rate, because sometimes a small percentage of your trades that you take actually account for the bigger percentage of your profits. But let's just go on this basis that this is an average strike rate. You can actually grow this a lot more. If you're risking 1% and you take 5 losses, naturally that's going to be 5 times 1, so you're minus 5. Now, this on an account balance, essentially because you're risking £100 per trade, that's minus £500. Now, if we have an average risk reward, when we're looking at charts, we're looking at positions, we're really looking at a minimum of a 3-to-1. So we want to look at, we risk 1%, but we want to benefit at 3% as a minimum. Now, it won't always happen like that, but that's what we're aiming for in terms of the patterns, the structure, and the strategy which you'll come to understand. So let's say, for example, our 5 wins are now 3 times 5. Well, what do we get? So we've got our minus 500, but we've benefited with this 3-to-1 at 15%, which is £1,500. So if we just do simple mathematics of net profit, 15% minus the 5%, so you've got your 5 wins here, you've got your 5 losses there, you're now left with a net 10%. And if we do that in monetary terms, we've got 1,500 minus 500, we're looking at £1,000. So what can we establish here? You've stuck to 1%, you're a low risk trader, and you're risking on a £10,000 account, but you was not so much right or wrong, because that's not what probability is, but you had 5 losses and 5 wins. So you was really sort of correct in that sense 50% of the time. That's absolutely fine. And you still managed to walk away with 1,000. You still had 10% for the month. So doesn't that go to show you that you can essentially have 50% losing trades and still be on top? Now, what happens when you've got, let's say, a 70% strike rate or 75 or 80% strike rate? So you can see how powerful that becomes. But this should give you comfort in the knowledge that even when you're learning to become consistent, the only way you break through to consistency is this model, sticking to the 1%, and you'll thank yourself later on down the line, because you could essentially have 6 losses in a row and then have 4 wins. And those 4 wins could average you maybe 3 or 4, sometimes 5 or 6%. We hit crazy returns compared to 3%. There's been so many bigger months. 3% is actually not that big of a deal, but we're playing the more conservative card here at the moment. But you can see how even on 4 trades at 4%, right, we're looking at 16% just on 4 trades. And then at the 6% that you lose, it's minus 6%. So keep yourself in this business long enough and stick to the low percentage. It will help you in the long run. And think about when you're trading, let's put another 0 on that, and then another 0. When you're trading a larger account, do you really want to be risking larger amounts and being emotional, or do you want to stick to something you feel confident in, that the mathematics is on your side? As you can see right in the bottom here, what have I got? I've got 1 to 10. As you can see, this represents essentially 10 trades. And all this essentially means is that we don't know our sequence of our wins and losses, right? We'll never know that if we're going to get win, 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 loss, loss, win, loss. We will never know exactly how that goes because it's probabilities. And I go into much more detail in episode 4, which you'll absolutely love on probabilities, that really gets you that probabilistic mindset. So stay tuned for that. But just briefly, so you understand what I mean by this, if you're new to Forex, you'll never know the exact trade is going to be a win that you take it, even if it's at high quality, because it's not about 100% strike rate, right? But let's say that you've got loss, that's why I've got the green and the red. So loss, 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 loss. So you've got 4 losses in a row, a win, a loss, win, 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 win. So as you can see there, this is this concept into this, but imagine what the emotional side would be if you took 4 losses in a row right at the beginning, maybe at the beginning of the month, maybe even at the beginning of the year. What kind of mindset would that put you in? Maybe these 4 losses happen to be actually just very good trades that didn't play out, because that's how it works. So you can see that although technicals are incredible, it's really the mindset, the psychology. And again, we have an incredible episode in episode 9, psychology, really breaking down why that happens, which you're going to hugely benefit from as well. But the psychology, that comes as a side effect of having great technicals first, and then they have to be congruent with each other. And you're going to learn that on a weekly basis with the mentoring in the community as well. But what is most important is to fully accept that you can have, let's say, what we would call a slightly slower start if you've got minus, 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 then a win. But think of it like this. You're at -4 here, and then you benefit from a 3 to 1, maybe even 4%. Just from one trade, you're still straight back up to break even or very, very close to that. You take another loss, that's fine, maybe -1, -2. Then these 3 trades, 3, 3, 3, 3, and maybe even more. So you see how you can come on top very, very quickly. So never judge yourself on the micro, look at the bigger picture. We don't even judge ourselves on a monthly basis because there's not enough data and there's not enough of the market movement of cycle for you to realize whether that was a bad month or not, because you could end on -1 for the month or just maybe 1 or 2% profit, and then for the next 2 months bank 10% and then 12%. So would you really look back on that first month and be upset, or would you look at the average? So we think more quarterly. That's what I really want to tune your mind into. Thinking on a quarterly mindset is more like an investor, and it's more of that longer term thinking which we want. So hopefully this just explains the overall concept. And again, this is non-compounded. And what I mean by that is if this increased to 11,000, then your risk would no longer be 100 because you're risking 1% of 11,000 and then the new figure, etc., etc. But this is just to understand the brief mathematics and concepts. If you stick to 1%, even on a slightly lower strike rate, you can still set yourself up for success. So as you can see, guys and girls, very, very simple. Understanding the power of the 90-90-90 is so crucial, so you can focus on what to avoid and set yourself up for success. And just realize that, look, even on a low strike rate, you can do very, very well. But of course, you're naturally going to increase that over time. Now let's take a look at a little bit more detail. So if we look at the basic knowledge of the FX market, understanding again that the FX market is open 24 hours a day, 5 days a week. So this allows us for fluid trading weeks within the opportunity. And then of course we can review those trades on the weekend where the market's closed and then set ourselves up to look at what are the best opportunities for the week ahead. Now with the stock market, it has odd hours, therefore price action is not available to you during those closed market hours. So it's really, really important, and this is one of the most popular things about Forex. Forex is much larger than the stock market, therefore it cannot be influenced by large companies or investors or mergers or anything like that, which is a huge, huge bonus for us. Now let's take a look at commitment. Now, the fact that you've joined the Falcon community and you've invested in your learning, that's shown that the fact that you're committed to change. And remember, your commitment to change needs to be stronger than just learning. It's not really about learning. It's about developing ways that you can improve and take charge of your life. By putting in the hours up front, this will naturally become second nature, but it's only for the focused that actually see this as a longer term picture. Falcon takes you from a complete novice to a confident trader with an incredibly strong mindset. Consistent traders can spend as little as a few hours a day on the charts, but first the work must be put in through patience, commitment, putting in a sickening amount of work ethic and hours. We've seen it even with things like musicians. We've heard of the 10,000 hours rules. It's the same thing. The more hours you put in, the more you're going to get out of it. And as a Falcon member, be prepared to put in the work and the effort required to achieve great results. And you got to understand, look, nothing worth having comes easy. And this concept most certainly applies to learning how to trade the FX markets. And the great thing is you will have all of the tools, all of the strategies to be able to do that. Now let's take a look at strategy potential. So your returns are based on your account balance and the trading capital that you have available to you. So any profits you make will be a percentage of your account balance. The goal with Forex is not to make a million overnight or not get rich quick. We've already seen massive success within the community from students at all levels within their trading. And we all hold each other accountable to ensure that we're all on the same page, heading into the trading week exactly, reading for the same hymn sheet. And I think that's the most important thing. Students have successfully and consistently seen results in the high double-digit percentage month on month. Falcon has created consistent amount of 6-figure, 7-figure traders, and it is growing by the day. So to have you part of that is just insane, and we're very, very excited to see that number grow and grow and grow. Now, understanding that is one thing, and this is something that people talk about a lot, wanting a work-life balance. Everybody has the time to do what is really important to them. We're never busy, right? It's all about priorities. We all have the same time. We just have different priorities. If you're serious about succeeding in trading, you must prepare yourself to sacrifice in other areas. It has to be done. Personal development, psychology, goal setting, and many other topics become a major part of your development as a successful trader. And this is what we love about trading. It encourages you to become the best version of yourself. Falcon is not just FX education. It's a worldwide community of inspired individuals pushing themselves out of their comfort zone to the outermost limits and just creating a better life for themselves. You are in the right place and have invested in the next stage of your life. And that is the most beautiful thing when you're committed to becoming that better version of yourself and making 1% tweak over and over again. And you're mapping out those goals and you're in an incredible community that's going to push you. That's a very, very powerful thing. And just understand you will have to make those sacrifices. But if you do that, you're going to be part of that small percentage of people that succeed within the markets. And it's getting bigger and bigger within the community. So very, very excited for that. But what I want to take you through now, guys and girls, is the power of something that what we call compound interest, because I think people underestimate how powerful it is. Even on a large account with smaller returns, you can still do a lot of growth, and you can even do that on a smaller account and start to grow that. The power of compound is insane. Let's take a look at that now. So now let's take a look at the compound interest calculator. This is something that blew my mind when I very first started learning, so keen to get into this. So let's take a look at the numbers. So firstly, starting off with currency, you can of course choose whichever you like. So this is a site that we're using. There's lots of different sites that you can use. So starting off with pounds, right? Now let's look at the base amount. We're going to play around with a few figures here, but we're going to start off with 10,000. Right, so starting off with £10,000, and we're going to do an annual interest rate. Let's start off on the lower side of things first. So let's assume that, of course, uncompounded, that we're looking at 3% a month, right? So we go for 36. So 36% for the year. This is a slightly lower return, but let's go more conservative for yearly. Over the period, let's look at 3 years. You really want to be looking at 3 years as a minimum, because I'll show you in the figures. And a monthly regular deposit, let's start off low. Let's say we're looking at £100. We're going to compound that daily, and we're going to calculate. So when we calculate here, as you can see, year one. So your deposits for the year, 100 times 12, £1,200. So this is your yearly deposits. And as you can see, at the end of the year, with a combination of your yearly deposits and your interest on making that 36% for the year, what do we have? Well, we're left with just under £16,000 here as we've grown. Now you can see in year two doing exactly the same thing with your £1,200 over the year, so £100 a month that you can do. Some people don't deposit monthly, it's entirely up to you. Some people can do more, but I'm just showing you the figures. Then we're looking at, in year 2, 24,000. Then we look at year 3, and we're looking more at 36. So it compounds. This is just 3% a month. This is a very, very low conservative return, as you can see. Base amount 10,000, interest rate 36%, 3% a month. What is that compounded? 43.31, just by compounding that over a 3-year period. Now, most people, what happens is they get to something like year 1 and they start blowing their capital because they think, right, I've turned that account into this, I've grown by about £6,000, I'm then going to start using that money, and they kind of hover around here. But that just shows you the power. Now let's take a look at the same amount on a different percentage. So now we're doing exactly the same thing. So again, we're looking at 10,000. So we have £10,000. Now I can appreciate not all of you will be starting at 10, but we're just using this for an example's sake. You know, some of you will start with 1,000, some 2,500, some even more than 10,000. Now, interest rate. Now let's say we've looked at 3%, so 36% for the year uncompounded and compounded over 40%. So let's say we're looking at 5% now, 5% a month. So 5% a month, what is that? 60% for the year. So looking at 60% for the year, and we're looking at that over a 3-year period, and regular monthly deposit. Let's do 100 again. So depositing 100, compounding daily, and we calculate. So what does that calculate for us? So what we have in year 1, again, same, 1,200 over the month, £100 a month. You're depositing over the year £1,200. And what does the balance equate to? So you started off with 10, and now we're looking at 19, more towards the £20,000 mark, pretty much 20,000 for the year. So what's happened there? What's the difference? You've gone from a 3% a month trader to on average 5%. So you've literally grown by 2% a month. And you've gone from your base amount of 10,000, your interest rate 60%, so 5% a month, and now compounded from 60%, that's now 82% over a 3-year period, right? So as you can see, look at year 1, now look at year 2, then year 3. So you go from pretty much 20, just under 40, to then 70. This is why people don't get to these areas, because they blow all of their money, they don't stick to risk, and they cannot see the power of it when it's compounded. This is what you need to understand. Not everybody compounds daily, some people compound monthly and things like that, but these are the maths, these are the mathematics, and it just shows you what is possible there. What I want to do now is actually take a look at this on a 5-year period, just to show you a few things. Let's take a look at this on a 5-year period, doing exactly the same thing. So now let's take a look at 5 years. So we change the 3 to 5, and we calculate. Now look at the difference. This is where it changes. So after the 3rd year, so we're looking at 70, right? At 20, you know, it's unlikely that you can quit your job on £20,000, or depending on what your lifestyle is and things like that. 37, then it's more respectable. It's something you can look at and think, well, that can replace my full-time wage after year 2. Year 3, that's when it gets interesting, you know. It's way above average, £70,000 for the year. Now you're looking at year 4 and year 5. This is where it grows exponentially. And that's when you can understand that most people won't get to that because they're just not willing to see it as a business, and they're not looking at it at a 5-year period or 6-year, 7-year period. And those are the people that win. And bearing in mind, this is just on 10,000. You know, the goal isn't to turn a 10,000 into pretty much $250,000. That's not the goal. The goal is to become the asset and learn the skill, and then just understand the mathematics. Now, when you realize that once you've got the skill, you're likely trading more than 10,000. You'll trade, 25, 30, 50, 100 plus. You can see the power. But even on small amounts, something that is obtainable for all of us, even if you're working, even if you don't have a very high paid job, you can save up that money and then have that money to invest once you are the asset, once you have the skill. I think that's really important to understand. So those are the figures there. I just wanted to go through some just brief things there. You can, of course, play around with the figures for yourself. I encourage you to do that on any compound interest calculator. And again, it just shows you what's the difference. What is the difference between a 3% a month trader to a 5% a month trader and beyond those figures? Sometimes it's just those small 1% tweaks. And as you can see, it's compounded in life in general. It's not just about money, it's compounded knowledge. What does that pay you in the long run? So understand that the tweaks that you're going to make in Falcon is going to encourage you to move closer to that. Having great processes as a side effect, you'll go from 3% a month to 5%, 6%, 7%. And as you can see, the growth is there. The maths are there. It's in your favor. You just need to put in the work. So as you can see, guys and girls, the power and the potential of compound. People really do underestimate this. And this is why your focus should be on learning. Don't worry about what capital you have right now. If you're focused on growing and becoming the asset, that will happen as a side effect. And as you can see, mathematically, it is on our side. So you're going to learn how to do all of that. But now I want to take you into what is Falcon. Now, Falcon was founded after over 9 years of overcoming challenges in the Forex space. It took me 4.5 years to really break through to consistency, and it was built off of a pure mission to inspire, guide, educate, and evolve people from all around the world to tap into their full potential and just live life on their own terms. That has been the most important thing from the beginning. Now, it's my profound mission to help every last one of you tap into that freedom that I've experienced through myself through trading. Now, I want you to expect massive growth, change, most importantly, and a lifelong network of like-minded people to help support your growth and progression. Guys and girls, welcome to Falcon. This is the start of the better version of yourself and the better version of your life. And I'm very excited to have you on this journey with the whole community. Right, guys and girls, I want to take this opportunity to explain to you the true core message behind the name Falcon. See, the name Falcon actually starts with a story that kept close to me for years and years, called The Falcon and the Crow. So what does that mean? Well, the Falcon and the Crow represents two types of people. So we start off with the crows. The crows, you have to understand their mentality. Crows can only fly at the heights of tall trees, where falcons, on the other hand, they can fly thousands of feet in the air. Now, in both life, you're going to be surrounded with crows and falcons. And the crows are going to be those people that try and bring you down, drag you down, pull you down to their level because they're uncomfortable with your ambitions. They're uncomfortable with the goals that you set. And it's important that you recognize that and you surround yourself with people like falcons, people that are soaring, people on the same page, the same level, same wavelength of you, pushing themselves out of their comfort zone. And in life, when you've recognized that the reason why they do that is because they feel uncomfortable with your success, they feel uncomfortable with that, they're going to look at you sometimes flying thousands of feet in the air and realize, well, you know, I can't do that, because that's their mentality. And you have to understand, as a falcon, you can always adapt and fly lower, but a crow can never fly at the heights of a falcon. So you've just stepped into a community of like-minded people, surrounding yourself with falcons, surrounding yourself with people that are going to push themselves beyond their limits and hold you accountable, tell you what you need to hear, not what you want to hear, because that, guys and girls, is how you truly grow. Falcon is a mentality, and I'm grateful to have you part of it. Congratulations, guys and girls. We're now at the end of episode 1. I hope you really enjoyed the start of your Falcon journey. There is so much more to come, and each episode just builds on each other. And at the end of that, you're going to have all of the key components and understand all of the principles that's going to set you up for success and learn how to treat trading like a business. Very excited for you to carry on with the course. And I hope you really understand the core principles of what Falcon really represents. You've just stepped into such a genuine, incredible community, and it's just going to be onwards and upwards from here on out. So next up, we go into episode 2. This is where we start to dive into the technical analysis side of things. Start off with the basics, and it gets more and more advanced. So I'll see you in episode 2.